Block has had a rocky ride over the past 2 years, with shares plummeting over 75% from all-time highs. Last time I talked about Block, they were trading for over $270 a share. Today, with shares less than $70, I figured it was time to update you on my thoughts on Block, including how they've made progress on their goals that I laid out for them back in 2021, and if I like the stock trading at today's levels. Welcome back, my name is Arias, and let's get right into it. Let's start out with some of the progress that they've made since I last talked about Block 3 years ago. If you go back and watch that video, the biggest thing I was looking for was integration between the seller and Cash App ecosystems. Square has started to deliver on some of that promise, as they now have implemented direct payments between Cash App and Square sellers. These transactions should be massively accretive to Block, as they both increase network effects and should serve as a higher value transaction than when someone pays with a credit card, because they should bypass that card processor. The adoption of Cash App Pay, as they call it, is increasing, as at the end of September, Block had more than 2 million in Cash App Pay monthly actives, doubling since June. That's an extremely high rate of growth, with a lot more room to expand to more active users on Cash App. Cash App has also rolled out lending, and in the third quarter, they originated over $900 million in short-term loans and had more than 2 million in Cash App Borrow monthly actives as of September. This again is very aggressive and successful growth with lots of room to go. For both Cash App Pay and borrowing products, it will be very interesting and important for Block's future to see if they can reach higher adoption rates as they have with Cash Card. Cash Card has expanded to 22 million monthly actives, with 30% of those transacting on any given day. That is a fairly large and frequent user base that should increase the value of Block's network, as spending through Cash Card drives inflows, a main source of value for Block. A final big ask from my last video was expansion in geographies for both Cash App and Square. And while disappointingly they have not come through with Cash App expansion to a large degree, they have expanded the Square seller system, primarily in Europe. This will be a big initiative to expand further into more markets, getting a foothold and growing from there. And while the lack of geographical expansion isn't good, this report from Hindenberg is worse. For those who don't know, Hindenberg does very thorough research and releases short reports on companies they believe to be fraudulent or overvalued in some way. They released a report on Block back in March of 2023, which sent shares down 14% that day. And for your reference, all of the documents talked about on the next few slides will be linked in the description below, and I highly suggest you check out the original source. Hindenberg accused Block of facilitating fraud and illegal activity and avoiding regulations. Much of this fraud is in the form of identity fraud, where you can sign up for an account under the name of celebrity and even get a Cash Card with that name attached, leading to fraud and scams. They claim that Cash App doesn't do enough to stop this activity. Additionally, they claim that a much too large percentage of Cash App's use is related to trafficking and substance dealing, and that Cash App doesn't have sufficient controls to stop the activity. A lot of their evidence has to do with criminal cases that have revealed that they were using Cash App to facilitate their activity, or through songs wherein people brag about using Cash App in committing crimes. From an investor's point of view, this may cause regulatory problems if politicians or law enforcement seeks to crack down on this behavior. It could lead to fines for Block or additional restrictions that make it harder to operate for the company, along with the moral qualms of owning the stock. However, likely the bigger worry for investors is the allegation that a large percentage of Cash App's accounts were fake. Hindenberg said that many people on Cash App have multiple accounts, which leads to massively inflated user numbers. This would be a significant blow to Block's story, as large Cash App user adoption is one of the pillars Block has built their ecosystem on. Fraudulent accounts would lower the real number of users acquired, which in turn raises the customer acquisition costs on a per-user basis, which is one of the reasons investors are so excited about Cash App. You're probably thinking, well, the lower true user count would drive up the true total revenue per user, so it makes up for it. But what that would really mean is that Cash App is much more mature and has less room to grow, because it has both less users and we already know the upper bound for a regular digital banking product, and they are closer to that level of monetization than we thought they were before, when the true user count was higher and the monetization per user was lower. This is a big allegation, and we'll see how Block responded to it on the next slide. An additional element to the fraud allegations was that Block facilitated relief payment fraud in 2020, and that governments had to try to claw back millions in payments from Cash App. They also said that this fraud was significantly more prevalent on Cash App on a per-user basis than it was with other large banks. On top of this, they alleged the classic company is performing poorly and executive cashed out, saying that Jack Dorsey specifically cashed out over $1 billion during these issues. It took a week, but Block responded. They addressed the allegations of fake accounts by saying that people have different accounts for different uses, and I agree, this is a totally legitimate use case in my book, to have a personal account and a business account and perhaps a third account for something different. But once you get above 3 accounts for one user, should this really count as additional users? The answer is no in my book, but Block still counts them. Let's see how that affects the numbers. Of the 51 million monthly transacting actives at the time, 44 million had verified their identity through Cash App's verification program. A further 39 million had unique social security numbers. That means that 25% of the 51 million either had not verified their identity or entered a duplicate social security number. This is a pretty big hit to numbers and would have a negative effect on my view of Cash App. But it's good that the number is quantified rather than remaining vague as it was after the allegations. Cash App was not able to quantify the amount of fraud or illegal activity on the platform, only saying they had increased investment in compliance. They didn't address other issues brought up by the report, like the lack of reporting on interchange fees or relief fund fraud. Overall, this brought up some serious questions over Cash App, which is a large part of Block's thesis. It didn't make the company uninvestable, as there's still a lot of value in their products, but it did succeed in bringing up issues at Block to be addressed. Management seemed to have realized the company is not being run in the optimal way and is now putting in serious efforts to rectify that. They are starting out with targeting achieving Rule of 40 operating metrics by 2026. David Sachs on the All In Pod has talked about Rule of 40 a few times, and it's generally thought of as having your revenue growth rate year over year and your gross profit margin adding up to 40. Block has a small twist on that, with them looking at gross profit growth rate rather than revenue growth, and adjusted operating income margin rather than gross profit margin. But generally speaking, these are both proxies of the standard metrics. By 2026, they are targeting mid-teens in gross profit growth per year and mid-20s adjusted operating income margin, which should add up and fulfill the Rule of 40. I think this is a solid goal for the Block team to aim for, while gross profit growth is already in the mid-teens at 16% in the third quarter. According to my math, they only have an adjusted operating income margin of about 4%. That would be a significant improvement in profitability to get to mid-20% as they are forecasting. I imagine a major factor in the increase in profitability will be slowing expense growth, which will be contributed to by capping the company headcount at 12,000. Being that they were at 13,000 when this was announced, they will be shedding some headcount and becoming a leaner, more efficient company. Management also greenlighted $1 billion in share buybacks, which is generally seen as a good sign of an undervalued stock. Jack Dorsey has also took over as CEO of the Square Seller division, showing that the side of the business will get more direct attention over the coming years. All of these changes have shown the company knows they have gotten a little bit off the right track, but are attempting to straighten it out and correct for their failings. While I talk about Block having relative struggles recently, especially with the share price, has that been encouraged by the numbers, or is it disconnected? In the third quarter, revenue ex Bitcoin was $3.2 billion, still growing while at a bit more modest rate of 16% year over year. That's made up with almost a 50-50 split of transaction revenue and subscription revenue, with subscription revenue generating the majority of the gross profit from a much higher gross profit margin of over 80% versus transactions revenues margin of around 40%. $1 billion of the $1.5 billion in high-margin subscription revenue came from Cash App, showing it is a margin-accretive product for the company, which numbers have now been folded into both Cash App and Square's businesses, contributed $258 million in revenue in the third quarter and $188 million in gross profit. Block acquired this buy now, pay later revenue for approximately 113 million shares, which at today's prices would be worth roughly $7.8 billion. 113 million shares is about 18% of the 614 million shares outstanding that generated about $188 million in gross profit last quarter. Thus, the 18% of share dilution generated about 8% of the revenue and about 10% of the total gross profit generated in the quarter. This is not terribly out of proportion, but I would like to see some further reporting from management on how well Afterpay's synergies are lending to additional benefits for the company working with Block's ecosystem. Gross profit was up 21% year over year to $1.9 billion, outpacing revenue growth and outpacing operating expenses growth, which was up 18%. They still have a decent balance sheet with $6.2 billion or more in cash and equivalents, depending on how you count it, and $4.1 billion in convertible notes. At the time of recording, Block was valued around $40 billion, giving it an annualized price-to-sale ratio of 3.1. That seems pretty reasonable to me, especially considering their gross margin of around 60% and the fact that they're still growing. Before we move on to my updated thesis on the company, I wanted to highlight an interesting few graphics from their shareholder letter regarding Cash App. On the left is Cash App inflows by quarter, which, while year-over-year growth remains high, has remained approximately flat for the last 3 quarters. That's something that I'd like management to dig a bit deeper into going forward so that investors can understand what's driving that and if it will continue. On the right is Cash App's inflow framework, and I've added the year-over-year growth rates as well. The framework starts with 55 million actives who, on average, each deposited $1,132 into Cash App last quarter. Cash App monetized those inflows at a rate of 1.43%, leading to their approximately $4 billion in Cash App gross profit. All 3 of these levels have room for growth, especially the inflow level. But if we remember the potentially inflated user numbers, that would drive up inflows per user, driving down room for growth. If we use that 25% handicap for these users that we were looking at earlier, that would lead to inflows per user of $1,509 on average, a 33% increase from today's reported number, which, like I said, lowers Cash App's short-term ceiling. Finally, for my updated thesis, I still think that Block's advantage is their unique ecosystem with sellers and consumers, all owned by one overarching company, and I think there should be a lot of synergies that come from that. That is the main advantage that they have over PayPal, Toast, Apple, and others. However, while this should allow them to generate more value from customers and expand more efficiently, I don't think it'll be a big enough advantage to beat other offerings on its own. Investors need to keep in mind that Block is in a highly competitive arena on both the seller and consumer sides, and that Block is going to have to execute well and continue to improve their offerings to stay competitive. I have some confidence that they can do that, given the synergies of their 2 ecosystems. What would really make them special and gather outsized returns for investors is if they can find a way to build highly accretive products from scratch with their own tech stacks like Cash App was. This is what keeps me interested in the company, and I will track it for developments of such value. Otherwise, I'm generally bullish on Block. However, I have not picked up any shares just because I like today's prices of other companies a bit more than I like Block's. Thank you so much for watching and have a great rest of your day.